If you flip houses or do any sort of ground up construction, you are not going to want to miss this video. So stick around to learn about hard money loan requirements and the credit score and reserve gap that debt consolidation fixes. So most borrowers assume hard money lending ignores credit entirely. The truth is way more nuanced, and understanding exactly how credit and reserves interact with hard money underwriting can mean the difference between a deal that closes and one that stalls just inches from the finish line. So let's get fair up it. Hard money cares less about your credit, but not zero about it. The common assumption is hard money lenders underwrite the deal and the property first. That leads borrowers to assume credit doesn't matter at all in the equation. And here's the reality. Credit absolutely matters in hard money lending. It works differently than a conventional financing. It doesn't gate the deal the way a bank would. Instead, it prices the deal. Your credit file shapes your rate, your points, and your loan to value structure from the moment a lender opens your file. So, where credit actually shows up. According to BE Lending and Crestmont Capital, hard money lenders operate within a clear credit tier system that directly affects what you can access. So below 600 narrows the lender pool considerably, fewer options, tighter terms, higher scrutiny across the board. 640 to 650, the minimum, bare minimum most hard money lenders require. And this is the floor to enter the market with reasonable options. Then 700 plus, that's going to unlock the best rates, the highest loan to value structures available. And this is where pricing truly shifts in your favor. So the points mechanic, how points are calculated. According to the credit people and AmRes, 3 factors move the points a lender charges. Credit score, borrower experience, typically over the last 2 years, and equity contribution. Each point saved can shave roughly 0.125 to 0.25 off your rate. A weaker file doesn't just mean a worse rate. It typically means more points due at closing on top of a higher rate, and the cost compounds at 2 levels simultaneously. So as a quick overview, for your credit score, a higher score equals fewer points charged at closing. Experience, proven track record reduces lender perceived risk. And then your equity contribution, more skin in the game, lowers your points burden. However, the reserve requirement most borrowers miss. Modern hard money underwriting typically wants 3 to 6 months of holding costs sitting in a borrower's account, separate from the down payment. These holding costs include interest, taxes, insurance, and utilities. Critically, these funds are not used at closing. They exist purely as proof that you can survive a project that runs long, a renovation delay, a slow permit, an unexpected repair. We all know how common that is. So you want a 3 to 6 month window of reserves, separate from your down payment, proof of staying power, and those reserves signal to lenders you won't default if the project timeline extends. Now, why reserve is harder to show than it looks. The reserve requirement sounds straightforward until you look at what's quietly draining the account. Minimum payments on stacked credit card debt eat into exactly the liquidity a lender wants to see sitting untouched. So debt minimums, minimum payments erode monthly cash flow, borrower fails reserve check despite down payment, and now we're looking at how debt consolidation fixes both sides at once. Rolling revolving debt, credit card debt, if you're over 50% utilization into one fixed installment payment is a dual action move that addresses both hard money hurdles simultaneously. Now, consolidate revolving debt, replace multiple minimum payments with a single fixed installment loan, freeing FICO score moves up, reduce utilization to the fastest level we can pull to boost your FICO in a single reporting cycle, and can push your score past the 650 to 700 threshold on the right file, which changes pricing and terms of your hard money. And also, you got your monthly cash freed up. Fewer minimums means more liquidity sitting in your account, making the reserve requirement genuinely easier to hit. Now, the debt consolidation doesn't just improve your numbers, it restructures your financial profile in the exact 2 dimensions hard money lenders measure the most. Because they don't give a shit about your DTI. They want to know where's your credit score at and do you actually have the liquid reserves sitting there to service it. Now, here's the recap. Hard money's not credit blind, it's credit priced. Points, rate, and reserve all move with your file. Credit score doesn't block the deal. It determines what the deal costs you at every level. The reserve gap is a cash flow problem in disguise. Stacked revolving minimums drain the liquidity lenders need to see sitting untouched. And debt consolidation moves the file before the lender looks at it. Fix the score tier, free it up the reserves in one move before you ever submit an application. Allow maximum 30 days because that score jump's going to happen within one reporting cycle, anywhere from 1 to 30 days. Now, let's map your deal. If a hard money deal is closed, but the reserve requirement or the rate tier is the sticking point, the next step is a direct conversation about your specific file. Is your score below 650? Debt consolidation may be the fastest path to crossing the threshold that changes your pricing tier. However, 650 is the minimum that you need to even access debt consolidation. So check that first, specifically on Experian. Failing the reserve check, freeing up monthly cash flow through consolidation could be what closes the gap between close and no close. And ready to map it out, head to gapfunded.com/apply and let's work through your deal together. Worst case scenario on earth is you walk away with a game plan. I'm Mick Wadley, founder of Gap Funded. Let's go close something. And if you adored this video, smack the subscribe, flog the bell, and I'll see you on the next one.